Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a senior manager and education coach here at Schwab, and this is Managing an Options Portfolio. And today, we're going to be getting a sort of introduction to a strategy that I don't think I've ever done in this webcast series. We're going to be talking about trading just a plain old Condor, not an iron condor, but a Condor. It's an option strategy that might benefit from a stock that just doesn't really do much of anything. So it's kind of a go-to strategy for those that think a stock is going to go sideways for a while. So we'll set an agenda for how we're going to proceed with that discussion in just a moment. But let me first of all say hello to everybody who's already chatting in out there in YouTube. Hello there, Bill and Jack, Austin, Eva, Boss, Life in the Fast Lane, Robert, Kevin, everybody else. Thanks for joining us week after week. We really do always appreciate your attendance and your contributions in these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, enjoy the presentation, but be aware that you're invited to join us in the live discussion. This is a Wednesday webcast series that kicks off promptly noon Eastern. We'd love to have you here. And I also want to let you know that my very good friend Brent Moores is hanging out in the chats with the live stream audience today. Brent's just going to be answering any questions that I can't get to. He brings a lot of knowledge, a lot of experience to this discussion. So thanks for helping me out there, Brent. And Brent and I would also like to issue an invitation to you, whether you're watching the live session or you're watching the recording. Make sure that you're following us on X. It's the best place to connect with your favorite presenters in between the live streams. You can find Brent on X at Brent Moores CS. You can find me there at Cameron May CS. But let's get into this. First thing we want to do as we get into this is, of course, hit the pause button to talk about risk. We need to be aware of the risks associated with investing. These disclosures are important, so bear them in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's set the agenda for the day. 3 items on the agenda, as there are each week in this webcast series. In this series, we maintain and manage an example portfolio of options trades. So the first thing that we're going to do is go have a look at our existing options positions. We're going to discuss the maintenance of those options positions, and I think there are maybe 2 or 3 that we need to do something with today. Next up, we're going to review market conditions to set the stage for the new trade that we're going to be adding to the portfolio, which is going to be, as a spoiler, a Condor. I already told you that, but we want to talk about how a Condor works, how it's constructed, how it might work out, how it might fail. So we're going to do all of that using an example on the Thinkorswim desktop platform. So there's our agenda. Just manage the existing positions, look at the markets, place a new trade. We're going to be placing a Condor. So let's go right to the desktop version of Thinkorswim. So this is the Thinkorswim desktop software platform. Can be downloaded from within your Schwab Online account. Just go to the Trade tab and you can download it there. It doesn't cost anything. But we have 6 positions right now in our existing portfolio. And since, say, the webcast series is called Managing an Options Portfolio, let's manage. First thing that I want to look at is Amazon. So with Amazon, we have a bull call spread. Sold a 210 call, bought the 205, should say calls, bought the 205 calls for the same expiration. Those still have 23 days left on those. And right now, not doing so well. This is one that stumbled straight out of the gates. Let's go see what's going on with it, see if the trader needs to do anything maybe. So we took this position right up here. You can see why a trader might have been taking a bullish trade if they're using technical analysis. Seem to be making higher highs and higher lows. However, Amazon, right after we took that trade, and these blue lines here really just represent our 2 strikes. I just drew those in. All of the lines and rectangles you'll see on the charts here, I just draw them in just for a quick visual reference point to sort of visually describe the structure of our trades. So here's our 205. There's our 210. But yeah, we fell back. Price fell back on Amazon, actually fell below our vertical. Came down, interestingly, I think here it's interesting that we pulled down, hit a low right here at about 195, which is coincident with the previous high. Old resistance, possibly becoming new support. And we've gotten a nice bounce since then. We need to try to get back up above our spread to be in position for a maximum theoretical gain up above 210. So there's still some work to do, but still some time to do it. So I think we're going to leave this one alone, let it continue to work, see if we can get up there. So with Amazon, we're going to leave that one untouched. Salesforce, we have a long call. Now, we actually had two just long calls that started off as diagonal spreads several weeks ago. And we closed out the shorts on those. That was on Salesforce and on Alphabet. With Alphabet, we decided to sell another sell another short call against the long position and turn that back into a diagonal. But with Salesforce, we just decided to hold on to our two long calls. There's still 114 days left till expiration. The reason was that we have an earnings announcement coming up, and for some traders, they prefer to not put a cap on the potential of a trade or just in advance of earnings. There are pros and cons to maybe potentially turning this into a diagonal spread, but we just have a long call, so we'd really like to just see Salesforce going up. And if we look at the chart, we own the 270 strike, which is down here. So we'd just like the stock to get higher and higher above 270. A couple of weeks ago, we peaked up here just about 350 bucks, sold off down to a low close to 320. And once again, maybe just an interesting technical observation, this low coming down and touching right off that quite prominent 12-month high. And we've rallied up from there. Now, this morning has not been cooperative. Stock's starting to peel back again. Still have earnings right around the corner. A trader might look at this and say, hey, even with this earnings, maybe we go ahead and sell an option right in advance of that earnings when premiums tend to be higher. Get some income here that might help us to offset some of the risk exposure on this long option. But that does put a cap on the upside potential of the long. So I think we're going to hold steady with this. We're going to leave just the two long options in place and see how the earnings treat us. Let's see. Bill says, can you share a workspace to transfer between live and paper money? So I don't typically share my workspace here, Bill. I will say, if you want to just bounce back and forth between live and paper money, one thing that a lot of people are just not aware of, you can't have both open at the same time. So for example, I could come down here to my Thinkorswim icon, right click on that, click on the Thinkorswim in the pop-up menu, and it's just going to bring up the login screen again. And we could go right ahead and log in to our live. At the same time, we have the paper money open. What I'll typically do if I'm doing that, and it's actually I do that fairly commonly, I'll typically leave the white background on the paper money and switch the live platform to the black background so there's a clear distinction between the two and I don't make mistakes thinking I'm placing a paper trade when I'm actually in my live portfolio. Okay. So let's get on with our positions. So we have Amazon, we have Salesforce, a little bit more cooperative this week, but retracing today. With Alphabet, we have the 165 long call that we purchased some time ago, and we've sold against that a 182.50 short call. Now, these now both have the same expiration. So really what we have here is a bull call vertical. We just like the stock to go up as far above 165 as possible, maybe even going above 182.5. Let's see what's going on with Alphabet. It was not cooperative. So here's where we sold that short call. You can see where I have that short call strike drawn in, just initiated last week. We've pulled back, bounced off an apparent low, which is also right at our long call strike. So we have some work to do. We'd like to see this rally. It's sort of rallying. We'll let it continue to work. NVIDIA, we have a long call vertical, bought the 130 calls, sold the 135 calls. We'd like to be above 135. Stock is at 132 right now. So with NVIDIA, here was where we'd like to be, up above our strikes. There are two lines here representing our two strikes. We'd like to be up here. Ouch, we've actually slipped down into our vertical spread. Now, with all of our spreads, what we have to remember is when we're in short options, In paper money, there's no threat of early assignment. That is not the case with real money. Real money trades can be assigned before expiration, and that the risk of that actually starts to go up a little bit higher as we go closer to the money. As we start to go in the money, that risk of early assignment can get dialed up. And as we get closer to expiration, so a combination of a couple of factors, the deeper in the money and the closer to expiration the contracts are, the higher the risk of early assignment. Now, it doesn't necessarily that even in those scenarios that the contracts will be assigned early, but we just always have to be aware of that. That's one lesson that paper money can't really teach. We just have to bear it in mind. So we have the luxury here of having that, at least that mental burden off our shoulders. I think what we're going to do with this, even though we've come down into the strikes, look at this. Just like on our earlier trades, we've come down and approaching previous highs. We'll see if those can hold this previous resistance. Could it act as new support, as it's done about 3 times already? Well, we'll call that twice already. If it does, and we can bounce back up, we could be within a day or two back up into maximum theoretical gain territory. So once again, not one of the trades that we're going to be doing anything with. But Visa and Walmart, I think we're going to be making some moves on these today. So with Visa, what's been going on with this? Well, this is a bull put spread that we took some time ago. If we click on a quantity, we can see when the trade was taken. So this was an October 30th trade about a month ago. And at the time, we collected a net credit between the two strikes. We just take the difference between the strikes. It's $1.30. Collected $1.30. That was the maximum gain. And we'd like to see that just decay away. Hopefully, the best case scenario is that we get out for $0. Get out for free. Well, if we look at the difference between those two strikes now, the mark means the current market price of those contracts, it might cost us about 6 cents. So in for $1.30, it might cost us 6 cents to get out. That's the full amount that we could still potentially make if we left these contracts on for the next 23 days. Now, we've been letting this go just so that we can talk about it, see if there are new developments that we can learn from. Really, this one just continues to cooperate, but it could go south on us. Let me show it to you on a chart. So here's our maximum theoretical gain territory, and you can see it just seems to be getting better and better. The higher we go, the better for this trade. Here are our 2 strikes down here. Maximum theoretical loss is all the way down at 280. And there's only 23 days. It almost feels like there's a certainty of profit on this trade. There's never a certainty on a profit on a trade until the trade is closed with a profit, right? So what could happen in the next 23 days if we get a course correction and we collapse hard, there's still risk that we might give away all of our gains. We could even fall into loss territory. And with a contract, do the math for me. For those that are new to vertical spreads, you veterans, let me know. If there's about 6 cents left that could be made, how much is there that could be lost? If we tally up surrendering all of our gains and even falling into loss territory. Well, on a $5 wide spread, if there's only 6 cents left to be made, that means there's $4.94 that could be lost. $494 per contract in pursuit of $6. Another consideration here is because of that potential for loss, that is tied up in essentially retained margin maintenance. So yeah, $500 is being tied up here in pursuit of $6. That might be worth it. We could also avoid commissions potentially if we just let these contracts expire worthless. But I think what we're going to do with this position is we're just going to close it up. We've been whittling away at this, chopping it down, realizing gains, chopping it down, realizing gains, and there's only a contract left. Let's right-click on this. Let's create a closing order and buy that vertical back. Let's see if we can get it out for 6 cents. I might even be willing. Let's dial it all the way up to a big old massive cost of 8 cents. That's right at the natural. If we click confirm and send, even though we might feel like we're being generous and saying we're willing to pay up to 8 cents or $8 to get out of these contracts, still not a guarantee that we're going to be able to get filled. We'll see. But there is a commission to be paid here, so total cost might run as high as $9.30. But having gotten in for $130 minus $1.30 in commissions on these contracts, still could be a nice realized profit. Let's send that order off, and we're out for 7 cents. Okay, in for $1.30, out for 7 cents. That's a nice gain. And Walmart is looking very similar. Let's look at our Walmart trade. Now, this is a great example of how we may get into a trade and think, well, I'm going to be sitting around twiddling my thumbs for a month to realize the gains on this, but actually those gains can pile up pretty quickly if the trade goes well. If it goes poorly, the losses can pile up quickly, of course. So with this trade, if I click on the quantity, we can see this is last week's trade. We only took this last Wednesday, and this is a bull put spread. We bought the $83 puts, sold the $85 puts. We'd prefer to be above $85. It is a bullish trade. And we collected a net credit of 45 cents. 45 cents, $45 per contract, 10 contracts at $450 that could be made as a maximum theoretical gain on this trade. And we're hoping to see this 45-cent value decay away to nothing. That's the best case outcome. Well, look at the net cost to exit right now. 16.5 cents minus 9.5 cents, 7 cents to get out, 45 cents to get in, 7 cents to get out. We may be able to net about $38 per contract right now. We'll see if we can actually get filled. But in 1 week, we've made $38 in unrealized gains. When we thought it was going to take us a month, because we placed this a week ago and there are 23 days left, so they were 30-day contracts at the time we took these trades. We were looking at making $45, $450 in a month. Instead, after a week, we're at unrealized gains of $380. So we've already made 80-ish% of our maximum calculated theoretical gain, and that's because of this on Walmart. And Michelle's saying bank it. And I think we are going to do that with at least part of this. Yeah, so we took this trade right here. And you can see how cooperative Walmart has been. It's been moving solidly into our maximum theoretical gain territory. We still have all this time for this trade to turn around and go wrong. Now, the probability is if we leave it alone, we'll make that other 7 cents. We'll make that other $70 that's still on the table. But there's also the possibility that we could give away all those gains and we could even fall down into loss territory. So, Michelle, yeah, I think we're going to bank at least some of that. Let's leave on some of this position. Just because we got in as a vertical spread with 10 contracts doesn't mean that we have to get out as an intact vertical spread with 10 contracts. We could start legging out of either side if we wanted to. Or we could take off. We could leave all 10 contracts intact and let them go. We could get out of some of those contracts, get out of all the contracts. And when I say we could, there's always a possibility if a trader is dealing with illiquid options, even with liquid ones, it can be a little bit hard sometimes to get out. But let's see if we can get out of some of these. I'm going to right click here. Let's create a closing order, and I'm going to buy out of, let's say, 7 of these. I'm going to let 3 of them continue to work so that we can continue to talk about and learn from those 3 contracts. If they happen to turn around and fall, well, we can learn from that. If they rise up and we're able to get even more profit out of them and maybe even sidestep the commissions that might have had to been paid, we can learn from that as well. But yeah, let's see if we can get out for, let's actually offer 8 cents to get out of these. I'm going to click confirm and send. Attempting to buy 7 of these verticals back, the 85, 83 put verticals, limit of 8 cents. So that's the maximum that we're saying we're willing to pay. We don't worry about the maximum profit or maximum loss here. This is not looking back at the trade that we're already in. These numbers would be as if we were to putting on a brand new, opening a new position. So we're not worried about this. But if we're able to buy out for 8 cents on 7 contracts, that would be $56 plus commissions. So a total of $65 to close this out. Let's see if we can do that. Now remember, we received 450 bucks to get in, minus some commissions. Yeah, so let's send this order off. So it was actually closer to $440. So if we're able to get out this, we're realizing a pretty substantial gain. Let's click send. Actually, not 450. That's for all 10 contracts. Anyway, got in for 45 cents, trying to get out for 8 cents. Let's send this off. See if we can get there. Let's go to our working orders. Okay, the mark right now is at 6. So we're saying we're willing to pay up to 8 to get out. The market price right now is only 6. I think our likelihood is we're going to get filled here pretty quickly. Yep, filled at 7. Nice. Okay. So we'll see how these remaining contracts go. We're certainly taking a risk in remaining in these contracts. There's a little bit of potential reward left, so there are pros and cons. We'll talk about managing those in future discussions. But now comes kind of a fun part. Let's add something new to this portfolio. But before we do that, a trader may not want to just willy-nilly throw in new trades. Instead, maybe they go take a look at market conditions and gauge what sort of strategy might be appropriate in their eyes for current markets. So I'm going to go to our charts and let's look at the S&P 500. And boy, yeah, it has been for the bulls a very cooperative last 12 months and going well beyond that. It's been quite a bullish market, but not all the time. If we look at this from left to right, the S&P has come up quite some distance, but really, if we look at like February, all the way through May, net, not really in advance. We went up, we went down, we wind up sideways. So there are definitely longer stretches, like from here to here. There's a stretch where not much was accomplished. We ran up, we ran down, we meaning the S&P 500, up again, down again, netting not much. And let's look at where we find ourselves right now. And I want to play the role of a trader who's thinking of maybe putting on a new trade for the December expiration. So we're going to do another one here for December 20th. Sim Architect says, are we seeing a double top there, or is that wishful thinking? That's a possibility. One here, one there. They're kind of close together, so it might not be signaling much of a retracement. Typically, when we see highs that are separated by a wider time frame, that might be interpreted to be a stronger signal of a potential sell-off. But I did want to talk about that, though. Let's say our trader is looking out to December 20th and are trying to decide, well, do I do a bullish strategy or a bearish strategy? Well, the markets have been bullish, so maybe I'll do a bullish strategy. Except in the short term, we've already run up some distance. There does appear to be some potential resistance right there that doesn't, it looks like we're still hovering below those lows. So that's a possibility, right, Sim Architect? But even if we continue to rise, let me pull down this right margin a little bit. You can click and drag your right margin so you can create more headrooms on a chart, or more, what do you call this, bottom room, I guess? Foot room, feet room, I don't know. Anyway, yeah, our trader might think, well, we've been going up, but if we get a proportionate move to some of these previous moves, maybe we go up just a little bit higher and then start to pull back. So if I'm looking for a trade here for December 20th and we're trying to be bullish, maybe there's not much upside potential. Okay. Now, we might also, let me just clear this drawing set. Well, maybe, like Sim Architect has proposed, we're hitting a double top here, or in any event, maybe today's selling continues for a while and we pull back. But then the bullish momentum of the last couple of years kicks back in. It might drive us right back up again. So where do we wind up here in both of those scenarios? Maybe not accomplishing much. Now, does that mean that this is absolutely what's going to happen? No, of course not. Maybe today is the beginning of a big sell-off. Maybe today is just a hiccup, in the middle of a large advance and we continue to rise dramatically, and we wind up here, who knows, 6,200 or higher by the December 20th expiration. Only time will tell, but let's just say that our traders' conviction is, it looks like maybe in their opinion, the most likely scenario is that we just wind up sideways-ish by December 20th, or at least within some given range. Let me just clear this whole drawing set again. Maybe at least their opinion is that we wind up somewhere between here and, I don't know, here. Just overall going sideways. Well, there are strategies out there. If we were bullish, maybe we put on a bullish strategy. If we're bearish, maybe we put on a bearish strategy. If we're neutral, maybe we just do one of each. And the same architect says, are you suggesting an iron condor here? That's what I've done a few times in the past in this webcast series. I just wanted to take a trade of a similar flavor, but a different construction. We're not going to do an iron condor today. We're going to do just a condor. Now, how many of you are familiar with a condor trade? As I ask that question, I want to clear up my drawing set. You now get my point about why a trader might take a position like this. This is a trade that's done when we really don't think a stock or market is likely to accomplish much before a given time frame. So I'm going to go to the trade. Actually, before we go to the trade tab, let's bring up our example stock. And I'm going to go with Microsoft today. It's not a stock that we have a position on in the portfolio already. So maybe we can gain a little bit of diversification in the portfolio. Sim Architect, Mo, you're not familiar with this strategy? It's quite similar. In my opinion, it's nearly identical to an iron condor, but it's different. It's different. Yeah. Michelle, you haven't heard of a condor? You've heard of an iron condor, but not a condor. Yeah, it's maybe not one that gets as much press as its possibly more popular sister strategy or cousin strategy, the iron condor. So with an iron condor, if you're familiar with it, you sell a bear call spread, bearish trade, and you sell a bull put spread, bullish trade. So the bearish trade benefits if the stock stays below a certain level. The bullish trade benefits if the stock stays above a certain level. And if we can just get it to stay where it is at expiration, that's how an iron condor works out best. So calls and puts are used in an iron condor. With a condor, you just use only calls or only puts, but it's still just a bullish spread and a bearish spread combined. So here's a typical condor construction. Let's go to our option chain. Oh, I skipped away from the Microsoft chart. I think you probably already know what I'm going to say. Let's say that our trader is looking here to December 20th, and they notice, really, Microsoft has stayed mostly above 410 for the last several months. It stayed mostly below 440 for the last several months, and it's right in between those two levels right now. And interestingly, the last time we crossed one of these monthly expirations outside of that range, let me extend our range here. Actually, let's do this. Let me right click here and let's extend that to left. And yeah, here we finished inside our range at expiration. The last time we closed outside of that range for a monthly expiration was right there. And out of the last, 1, 2, 3, 4, 5, 6, 7 expirations, we've closed inside this range. So our trader, let's just say that their plan here is, hey, if we can just close inside this expiration one more time, maybe I'd like to benefit from that. Tom says, is it negative theta? Nope, this one's going to be positive theta, which just means time is going to be working in its favor because we're going to position it so that the stock is already where it needs to be for this trade to have its maximum theoretical gain. That's really what determines whether we're having theta working for us or against us, whether we're long or we're short. But here's the concept. If you're familiar with an iron condor, this is going to be fairly straightforward. If you're not, it might be a little bit more work. But let's look to maybe set up a bullish vertical spread down here that will benefit if our stock stays above 410. Okay, I don't want to draw an oval. Let's remove that oval. Let's switch up our drawing tool and let's go with our trend line tool. So let's set up a trade that if we stay above that 410, we stand to benefit. So I'm going to right click here. Let's edit the properties of that line, and I want to give it an arrow here. Let's see, is it this one? Yep, there we go. And at the same time, we're going to set up a bearish trade up here that stands to benefit if our stock stays below that level. So let's right click on that. Let's put an arrow on that one. So this is what we'd like our stock to do, stay below 440 and above 410. So what we're going to do to structure this is we're going to do a bull call spread down here. And maybe we'll set it up at the 405, 410 strikes. Let me actually redraw this line. I'm going to remove that drawing. Let's start it out here so we can just tell that we started this trade on November 27th and carry that out through December 20th. And then at the same time, so we'll do the 405, 410 bull call spread. And at the same time, we're going to do a bear call spread up here. Let's make it roughly equal distance. And how about we do the 445, 440 bear call spread? Take that out to right there. There we go. So that's the way that we're going to structure that trade. So let's go to our option chain, and we'll map this out over here for those that are new to this strategy. We're going to go to the 20th of December, and let's start with one side of our example trade. So our example trade is just going to be a call Condor. We're using calls to construct it. It's not an iron condor. It's just a condor. So out here in December 20th strikes, our support was down there at 410. So let's maybe look at buying the 405 call and selling the 410 call. So if we buy the 20th of December 405 call, that looks like that's trading between 21.75 and 22.05. Let's split the difference and say it might cost us 21.90. Okay? And then at the same time, we're going to sell the 20th of December 410 call. What is that trading for? Between 1750 and 1780, we'll call it 1765. So what does this do for the trader? What they're doing is they're spending a net debit here, spending 21.90 and then receiving, and these are estimates obviously, if and until an order fills, but if we spend 21.90 and then retrieve a credit of 1765, what's the net cost there of this portion of the trade? About, what is that, $4.25? $4.25. So what does that 425 do for the trader? We're spending 425 bucks. Well, it sets up a scenario where the trader has the right to buy shares for 405 and sell those shares for 410. That would be a $5 profit if it were a free trade, but this is costing us $4.25 to set up the trade. So we're trying to turn $4.25 into $5. That would be a 75-cent profit. And really, the conditions under which this would be accomplished is if our stock is above 410 at expiration. Hey, then we buy the stock at 405. The shares are purchased from us at 410 with very rare exceptions, and we've made our money. So it's a bullish trade if we're above 410. Look where we are right now. We're close to, we're 423, working our way maybe toward 424. So well above 410. So that's the bullish call spread. Well, at the same time, and maybe what I'll do, should I separate these by a line so you can see conceptually they're two different trades? Do we do put prices on the bottom? Nope. We're going to stick with the calls. So this is a bullish call spread that works best if we're above 410. Now we're going to do a bearish call spread that works best if we're below 440. So we're going to look down here on the calls still. How much could we sell? We're going to sell the 20th of December 440 call for between 212 and 217. We'll call it 215. Let's say we can collect a credit there of 215. And then we're also going to buy the 20th of December. We're going to buy a less expensive call. Let's keep the distance equivalent to the distance between our two strikes on the long call spread. Let's do the 445 call. That looks like that's trading between 132 and 136. Let's just call it 135 again. Okay. Let's say we buy that for 135. So what are we doing here? Well, we're receiving a credit of 215. We're paying $1.35. So the net between those two, it's an 80-cent credit. And for that 80 cents, we now have an obligation. Someone has the right, when we sell a call, someone has the right to buy shares from us for $4.40. We don't necessarily want that to happen, because if we need to, we may have to pay as much as $4.45 to buy those shares to deliver them. So if we were to buy at $4.45 and sell at $4.40, we'd lose $5. Against the 80 cents that we received, there's $4.20 of risk there. What do we want these contracts to do? Well, we want these to just expire worthless, which happens if we're below 440. Now, even an out-of-the-money contract could be assigned. There's still that risk. But the objective here is to be between the two short strikes. If we're above 410, our long options get assigned and exercised, and we turn our $4.25 into $5. If we're below 440, our short options expire worthless, and we keep the 80-cent credit. That is the not the iron condor, just a condor. And I think you can see how this is very similar to an iron condor. The preference is here for the stock to stay in this range. So let's do this. Let's draw. Oh, and by the way, how much can we actually make on this trade combined? If we turn 425 into $5 on our long vertical, how much can that make? Well, that would be a 75-cent profit, right? Let's do this. Theoretical max gain is the 75 cents that we could make in turning our 425 investment in the long spread into $5. That would be a 75-cent gain. On our short spread, we have a net credit of 80 cents. That's the maximum gain on that trade. So if this trade works out, we combine the two, that would be $1.55 maximum theoretical gain. KT Doe says, would that selling and buying happen automatically? Yes, any in-the-money contracts at expiration. Now, this happens automatically at expiration, not before. At expiration, all in-the-money contracts are automatically exercised unless there's a do not exercise set of orders left by the trader to just let the contract expire, which is not very common. Anyway, so yes. Now, if there's an early assignment before expiration, it's not usually in the trader's best interest for their long contract to be automatically exercised. So those are not automatically exercised. It's still up to the trader. They can choose to exercise if they want to, or they might choose to buy any long shares that they were assigned, or sell any, or buy to cover any short shares. All right, so this is how much we can make on this trade. Is it helpful if I break this out a little bit further? Let's give ourselves a little bit more room here so we can see the elements here. So with this one, this is a net debit, also known as the maximum or theoretical maximum loss of the long vertical. Well, we spent 425. That's the 2190 minus the 1765 if my math is correct. Always double check my math. I think I'm right, but I'm just doing this in my head. So if I get anything wrong, let me know. How much can we make on this trade? The theoretical maximum gain on our long vertical is $5 minus the cost to set up that trade. That would be the 75 cents. So those are just the elements of our long call vertical. The short call vertical, well, we have a net credit, which is also the theoretical maximum gain of 80 cents, leaving a theoretical maximum loss of $5 minus that 80 cents. That's the way credit spreads work. So you might look at this and say, well, okay, so we can make 75 cents here, and we can make 80 cents there. That makes sense that we can make $1.55. But isn't it possible that we could also lose 425 plus 420? Couldn't we lose? What is our maximum theoretical loss here? It seems like it's going to be $8.45. It's not. It's dramatically less than that. With this long spread, how much can it lose? It can lose 425 if our stock is below 405. Our short spread can lose 420 if our stock is above 445. It can't be below 405 and above 445 at the same time. So we can only lose on one side of this trade or the other. We can gain from both if we're in between the strikes. Yep, Howard, you can only lose on one side. Exactly right. So really the maximum loss is $5 minus the maximum gain on this trade. It's $3.45. There we go. In other words, if the stock were to close up here, I'll just say this quickly. If the stock were to close up here above 445, our short option, our short contract hits its maximum loss, but we have the credit received, plus our long option, our long contracts would have made their maximum gain. Yep, it limits that loss potential to 345. So this is where we'd like to be. Up here, this is the no-fly zone. This is where we'd like to avoid. Let's right-click on this, edit that. Let's make it red. And we'd also like to stay away from here. Those are our maximum theoretical loss territories. There we go. Yep, so we want to wind up right in here. That's our optimal outcome. And we'll see, we could fall below 410. We could rise above 440. But if we just do what we've done 7 out of 8 times, maybe we can optimize the outcome of this trade. Let's place our trade. Here's a quick way to place the trade. When we have multiple legs on thinkorswim, just hold down the control key on the keyboard and start clicking. So let's see, we wanted to buy the 405. Let's click on the ask price. And then we wanted to sell the 410. That creates our, I'm holding on the function key. Let's try that again. Buy the 405. Click on the bid price to sell the 410. There's our bull call spread. And now we're just going to go and do the bear call spread. That's going to be right here. Let's sell the 440 and buy the 445. Did I get that right? 405, 410, 440, 445. Yep, that's it. Looks like 345. Looks like that was about the maximum loss we were calculating. It might be a little bit more than that. Let's dial this up. This is going to be done at a net debit. Let's say that we're willing to spend up to 360. That means the maximum gain on this trade might only be $1.40. But let's click confirm and send. We're going to buy that one Condor, try to get in for 360. It's a limit order, so there's not always a guarantee. There's not a guarantee the order will fill. There is a commission. This is where the trader might decide, well, how much can we afford to risk. How about let's dial this up a little bit. How about we do 4 contracts for this trade? Click confirm and send. That gives us a maximum profit of $560, maximum loss of $1440. There is a commission to be paid here, multiple contracts, multiple strikes. Let's send that order off and see if we can get a quick fill. But as we wait for that, guys, that's accomplished what I set out to do today. Yep, there we go, in at 350. That's a nice round number. Could lose up to 350. Could make up to $1.50. And here's our landing strip. We just want to be between 410 and 440 for that $1.50 outcome. Michelle, was that new for you? Well, I hope that was new for a lot of you. There's always something new to learn, right? So we'll see how this Condor goes. In future webcasts, we'll follow up on the management of this trade. We're just hoping that we stay between 410 and 440. But we've managed our existing positions. We looked at the markets. We placed a new trade. In this case, it was a Condor. So this is what we do on Wednesdays. I hope you put it in your personal calendar to join me on Wednesdays in the future. But also make sure that you're following Brent and me on X. You can find Brent there at Brent Moore CS. You can find me there at Cameron May CS. We'd love to have you there as followers, and it's also the best place to connect with us in between the live streams. And also make sure that you have subscribed to our Trader Talks channel. This is the best place to find our playlists of previous webcasts. Subscribe to our channel on YouTube. You can find our playlists there. You can also join the live streams. Following on X and subscribing on YouTube don't cost you anything, and they only take a second, so click on that. And everybody, thank you for all of you who have already clicked the like button. I can see 45 of you have already clicked that like button. That's always appreciated, so thank you for doing that. Time for me to let you go. Go enjoy the rest of our webcast for the rest of the day. I'll see you next Wednesday for another discussion of managing an options portfolio. I'll look for you in other webcasts between now and then. Have a happy Thanksgiving, everybody. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.